Yeah. In this session, let's primarily focus on the regulatory aspect or probably the governance aspect. We also have another chapter on working capital management. We'll take that slightly after this one because this is more lighter in nature and probably more of a theoretical reading compared to doing some kind of calculation. So, what we'll do is we'll first try to understand from the corporate governance standpoint, what is that every company has to typically follow, and what is it the company is, what are the various things which the company has to get into from the shareholder satisfaction standpoint. See, because what typically is happening is shareholders buy the shares of the company, but they don't get involved with the day-to-day operations and management. It's like you have invested in a business, but you are not taking care of the operations of the business because of the size of the investment as a whole in the business. You are becoming a very minority partner in the business, and because of that, how do you know that your money, whatever you have put in buying the shares of the company, is put to the right use within the company? And from that standpoint, the norms of corporate governance has come into picture. When we say corporate governance, the intention is primarily looking at what is that the company is doing for the benefit of the shareholders. What are the things that are there within the company which ensures that the shareholders are not getting deceived. The money of the shareholders is not used in an improper manner or for fraudulent purposes. Whatever the investment that has come in, whatever the capital that has come in from the shareholders, everything is put to the right use. That is what is being mentioned in a kind of a manual called Corporate Governance Manual. Every public listed company should maintain that as a part of its corporate governance practice. So it should be there as a part of the annual report of the company, or it can publish it separately, saying this is our corporate governance scenario. What it is primarily, this is also the role of the finance department within a company. Come up with a corporate governance manual, make sure that all the activities of the company are in line with the corporate governance practices itself. Because at the end of the day, shareholder is the person who has put in money into the business. Apart from promoter is also one of the shareholders. So shareholder is the guy who has put in money into the business. Whereas employee is the person who is taking a salary for the services which he is offering. Or manager is a person who is taking a salary for whatever he is doing. The end objective of a manager in any company or of an employee in any company is to work in line with the shareholders. Make sure every task which they take up, it increases the value of the shareholders. It's not their own pet, because they have nothing to do with the company. If there is a loss, it's a loss to the shareholder. It's a loss to the promoter, but it may not be a loss to the manager or an employee, because he has no financial stake. He's like a person who is taking a fixed income as a salary for the services which he is offering, right? So how does the company make sure that whatever it is doing, it is in the interest of the shareholders itself? So that's where every company will come out with some set of controls, processes, procedures which are running the company. And every company will have a set of people called board of directors. These are the people whose main role is to ensure that the shareholders' interests are fully protected. So it will clearly define what are the roles, responsibilities of the management, the board of directors, whose major role is protecting the shareholders' interests. and what are the roles of the shareholders. And primarily, some of the key things which we need to understand in this process is the board of directors should be independent of the management. Probably you have to just look at different companies' corporate governance practices. Some companies we will see that majority of the board of directors are again the managers of the company, CEOs, CFOs. These are the people who are again there in the board. But for some companies, there will be a large number of independent directors who don't play any kind of management position in the company. Those are called as independent directors. Whereas CEO, CFO who are involved in the regular day-to-day operations of the company, they are not non-independent kind of directors or executive kind of directors. So non-executive directors and executive directors. So as an investor or as an analyst, I need to see the mix of these two. Because if management and board both are one and the same, management decisions will be same as board decision. So board is nowhere acting on behalf of the investor, on behalf of the shareholder. But the major intention should be board is existing because it has to act on behalf of the shareholder, because the shareholder cannot involve in day-to-day operations of the business. Board is treated as a representative of the shareholders. Board is not treated as a representative of the management at all. So whenever the issue comes up, the first people who are questioned are the board of directors only, because they have to be a representative of shareholder, and every task, every major activity of the company will move forward only if the board of directors have given their approval, and the board of directors have to give their approval only if they are fully confident that this activity of the management, this project of the management will increase the shareholder value. Right? So that's where we have to ensure that the board is more and more independent, and all the people in the company, they are acting in an ethical manner, and all the financial reporting and everything. See, every company publishes its annual report, which contains so many things, including the financial performance and corporate governance activities and the operations, the plan for the next year. A lot of things go as a part of the annual report. Make sure that the annual report contains all these things, and it is published every year without failing. Make sure that whatever the company wants to convey to the shareholders, that entire thing is conveyed and communicated. So some of the practices, because the majority of the shareholders are minorities, right? We very little stake. So the corporate governance practices are primarily targeted towards them. So majorly they should be focused on independence of the board. So if you open probably the annual report of Infosys, the annual report of some other company, there will be a clear-cut demarcation saying these are all independent directors, these are executive directors. There will be a clear-cut mention, which means these guys, they are just on the board. Probably I may be a board of some company, but I may not be involved with the operations of that company at all. Only the final decision, and that too, the decision, the only perspective I will see is, will it benefit the shareholders or will it not? I'm not saying is it a good decision or a bad decision. As a board member, my job is to evaluate whatever the decision the company is willing to take, will it benefit the shareholder or will it not benefit the shareholder? Prime stuff, right? Is it something, a pet project of the management, which may not give any benefit to the shareholder immediately? Then the board has to object that kind of move, right? Probably in the typical Satyam Mehta story, we have seen the same thing. The board has objected the management buying out of Metas, and that is where the whole thing got broken out. So board, if it really senses that something wrong is going in the investor's way, they can very well object the move of the company and the management. So if there are more independent people, it becomes more and more objective. Otherwise, there is a lot of subjectivity, lot of undue influence, all these things will come up. So if the company really wants to promote a kind of image with the investors, it will make sure that there are a lot of independent directors on the board. And so the major intention being the protection of shareholders' long-term interests. And some of the most desirable things are, let the board not contain the CEO or the ex-CEO of the company. And also evaluate the regular meetings of the board without the management's presence. So board only meeting. So each and every details of the board meeting also are present as a part of the annual report. Who all are present? Right? So any board member just absent for so many meetings, they are all kind of hindrances. They are all probably need to be evaluated by the analyst. So regular meetings without the management, because even if a CEO or CFO is there in the meeting, probably it may do some kind of biasing. So only the board meeting. And shareholders, see, the major thing that needs to be looked at from this perspective is shareholders having a voice in the governance. Shareholder, if he is raising some issue or if he is giving some suggestions for improvement, because he is also a kind of a owner, right? So the shareholders' voice in the governance and the operations process of the company. If there is an independent board, shareholders' voice is heard. Okay, if he is giving a worthy suggestion or if he is giving if he is raising a kind of an issue or a complaint, some kind of resolution of those things, the mechanism would be drawn for that, and all these things will be operated. Because so many minority shareholders only will add up to a bigger value. Even if one of the guys are ignored like that, it will have a negative impact from the company's standpoint. And what is the experience and expertise of the board, because it has to make sure that every decision it is providing its approval to that. So unless it has the required amount of knowledge, experience and expertise, they cannot question the management. So we have to be ensured that that much of experience and expertise is present. So even the qualifications, experience, everything of the board is mentioned in the report. Even on the websites of the companies, that entire details are present. And also evaluate if the board is composed of customers and suppliers of the company. Again, a biased decision may come. If the board is present from a supplier, so all decisions will be favoring that supplier itself. So make sure a lot of independence exists in this entire activity. And on what process the board members are hired. What is the interview process? How open is that interview process to get members onto the board? Is it just a nomination or is there a proper procedure, some committee which is getting into it? All these things have to be evaluated very carefully. And the better thing is, the moment we read one company's annual report, we get this entire details of that particular company. Some of the key things that needs to be focused both from an exam standpoint as well as usage. The frequency of board elections. The directors, are there annual elections or are there staggered multiple year terms? Which means probably is it like the whole board is there for a longer period or elections are held every year? If the elections are held every year, see, if it is like, okay, the same board member is continuing for last 10 years, there is a good chance that the management and board member, they can collude. There could be some kind of secret agreements between the management and the board member. But if the board member elections are happening every year and different people are getting nominated, or every year at least some portion of the members retire, instead of all coming in at same time and all leaving at the same time, if it is at least like, okay, 1/4 of the people retire at the end of every year, In that case, there is an advantage, right? If 1/4 of the people retire at the end of every year you are getting fresh expertise, and at the fresh views are coming up every year, and at the same time some experience is also existing. Not all are new, not all are old. So those kind of annual kind of elections are something that are more preferred. So even their election procedure and all you need to understand. And what is the company's stance in terms of filling the vacant terms without the shareholders approval, which means there is some collusion. If a shareholder is not informed about the filling a vacant position, because probably shareholder also can nominate someone. So without information to the shareholder, if these kind of things are happening, then it is something that needs to be alerted. Because uh, every recruitment has to be informed to the shareholders. And shareholder, does he have a right to remove a board member? Right, some companies do offer for that. Again it goes with a vote, right? Probably if all small shareholders come together and their number of votes go significantly higher, they can even remove a board member. So what are the policies of the company with respect to removal of a particular board member? And what is the size of the board? How many directors are there as a part of the board? Right? If there are more number of directors, probably there is a possibility that I can nominate one person to the board. Let's say if there are 20 directors, which means almost 5% votes can bring in one director. But if there are only 5 directors, I need to get 20% of the votes to send in one director. So probably I may not be able to pull 20% of the votes and send in one person. But if there are 20 directors, I just need to pull 5% of the votes here and there is a chance that I can nominate one person as a director of the board. So those things will bring in a sense of ownership into the investors. So from an independent standpoint, make sure that the decisions are not controlled by the management. They are not biased towards the management. They protect the interests of the shareholders and make sure none of these things exist for the board members. They are ex-CEOs or even some kind of relations with the family, relations in terms of families of those management or those kind of people. Make sure to a large extent, from a company standpoint, if it has to maintain that level of trust with respect to the investors, or from an analyst standpoint, if he has to really trust the investment in this particular company, probably the better things to evaluate are these things. The board does not contain any of these relations. Shareholders with controlling interests, even this is also an important aspect. Let the board member, let's say if XYZ is nominated onto the board of Infosys, right? First thing, make sure that XYZ is not related to any of the senior management of the company. Forget about senior management itself. Even if he is an outsider, make sure that outsider is nowhere related to any of the senior management of the company. One aspect. Two, make sure that XYZ does not have too many shares. Let him have some shares of the company, but not a controlling share. Probably 20%, 30% of stake. See, if he has 5%, 3% share, probably in order to protect his own interests, he's actually protecting the shareholders' interests. Of course, if he does not have shares also is very much fine. But if he has a very little amount, probably along with shareholders' interest, even his personal interest also is playing a major role. So he will not approve anything which is going against the shareholders. Right? So let him mandatory, make sure that he does not have a big sizable controlling interest, but let it be a very minute, just like a minority shareholder, he is also another minority shareholder. Until that case, you don't need to worry. But if he is having a very significant stake in the company, then probably the decision could bias the management and himself rather than the very minority shareholders. and make sure that he is not one among the firm's advisors or auditors or their families. Let the company CA or someone from that CA firm come into the board of the company. Again, there could be a lot of biasing. So basically, you have to evaluate the profiles as well as the qualifications and everything of the board member, his experience. Make sure that none of these things are typically happening. Cross directorship is a one important aspect to look at. It's like this: the CEO of Infosys, the director of ICICI Bank. I mean, just giving an example. If probably it's like CEO of the Infosys being kept on the board of ICICI Bank, the CEO of ICICI Bank being kept on the board of Infosys. This is what we call as cross directorship. The owner of one company kept on the board of other, and that other company kept on this board. This again could lead to, though in isolation I look at them as independent, but because of this relationship it is no more independent. So make sure these kind of things typically are implemented. That is when we say the board is completely independent, and the more the board is independent, the more that particular company will be trusted. And apart from looking out for the independence, so as a shareholder or as an investor or as a financial analyst, these kind of things need to be looked at from the corporate governance practices of the company. And you are also looking at the qualification and experience of the board member. So in this kind of a business, right, probably if he has come into a board of Infosys with respect to software, services, deliveries, these kind of things, what is the kind of experience he brings? Does he have some amount of understanding on the way the software industry works? Or does he have any of the hold in any of these operations, accounting, auditing kind of issues? Does he have any experience in handling the legal issues? How good he is at strategy and planning and risk management? These are some of the expertises of that person, because some people may be good at auditing. The board is not one person, right? The board is again a big list. So at least all these things are present in one or more of the board members. So that is what can take an effective decision in terms of probably questioning the management. Otherwise, management decision is simply passed as the board's decision. We are also looking at the ethical stance of the person who is coming into the board. Were there any instances earlier where he was found guilty on any of the board? He was there earlier, and were there any instances that something wrong was done by him? Or probably how many boards he has been on, how many boards did he stay till now, and in how many boards he came out very clean? Those kind of instances and ethical stance. What is his ethical stance on various activities? Experience on other boards? How good he is at attending the meetings? See, some people just for the sake of being on boards, they will be there, but they will never attend any meeting. So so from that standpoint, we have to look at how much of shares do they hold? Is it a very minority stake or is it very significant? And how long is he been a board member in that particular company? The longer the time period he is there, there is a good chance of collusion with the management. So if he is just 2-3 years, probably 5 years, he can add experience. But the very long, probably it acts counterproductive also. So those things. And one more aspect that we need to focus on is, now the board has the right to appoint committees. It's not the company which appoints audit committee. Auditing of the financial statements, hiring an auditor, external auditor, they are all the responsibilities of the board, not the management. Right? Probably management has to make sure that all processes are followed correctly. But who will be brought in as an auditor? That will be decided by the board, which will form an audit committee. So the audit committee's role is make sure that the entire financial statement of the company, it is shared with the shareholders appropriately. The annual reports are shared properly with the shareholders, and it has to make sure that accounting practices are followed as per whatever the norms, GAAP, IFRS, whatever it is, the accounting standards are simply adhered to. These are the people who will be responsible for appointing the external auditor. So the external auditor has nothing to do with the management influence, because the board is typically appointing that external auditor. And any conflict of interest that comes between the auditor and the management, right? Generally, auditor questions something. Why did you not have this kind of a practice? Blah, blah, blah. Management will argue in that. Final decision is with the board. Final resolution is with the board, and it has to be taken in favor of shareholder, not in favor of the management. Right? One. And even if they want to cut down any auditor at any point in time, they can cut down, which means this year they have engaged, next year if they don't want to continue with the same auditor, it's not a management decision, it's the board's decision. And even the internal auditors, see, the external guy, the moment he gives no, I mean the company is not following the standards, then it becomes a black mark on the performance of the company altogether. Share prices will go down, all these things will come out in one single shot. So every company will have a set of internal auditors who are more like employees itself, who will make sure 100 times that whatever the financial statements that have been recorded, they are all as per some standards or the other. They are not deviating from the standards, so that when they are presenting it to an external auditor, there is no way that he can point out any of the issues. That is what is an internal audit in every company is typically doing. So even the communication with the internal audit team is also done quite regularly. Even the audit budget is what is being set by the board itself. So the higher, so board is actually setting up a committee called as audit committee, where again there will be some independent directors and some people from the management. It will form one committee who's responsible, who will report to the board, not to the management, right? And whose typical job is make sure that the auditing processes are helping the shareholders itself. Then there is another committee which they set up called compensation committee, because management let it not decide its own package. Right? The salaries of CEOs, CFOs, someone has to decide. If CEO himself has the whole power, then he will decide his own package. So that is where the board again is making sure that it appoints what is called as a compensation committee, where every executive's salary is decided. Right? Probably at a very lower level, the information from the various managers is taken into consideration, but they give the big direction. Okay, this year let's increase the salaries by 5%, 10%. So probably the whole compensation aspect, right from senior management to a lower level executive, that entire thing is typically taken by the compensation committee, because the more the salaries are being paid, it will have an impact on the expenses of the company, which will reduce the profits of the company, right? And probably the shareholder value will get badly affected. So it has to make sure that all these things are taken into consideration. So the compensation committee is setting the compensations, and the major thing is, okay, if the salary is not increased, probably people may quit, which could impact the long-term profitability of the company. So it has to balance between how much salary has to be paid versus no payment. So it's a kind of balance that it has to strike. And the whole details, especially the higher level guys, CEOs at the top level management compensations, and even the board compensation. Board members, some of them will be honorary, but some of them will be paid members. So whatever is being paid, sometimes they are paid on per meeting basis. So, depending on the kind of services, even the board members' compensation has to be clearly coordinated with the shareholders. And if at all there are any share-based compensation plans, what are these share-based compensation plans? Stock options, right? You give some additional shares as a performance appraisal. As a part of the performance appraisal, instead of giving him some cash, you are giving that employee some shares of the company. In that case, the overall number of shares are getting increased. Per share price is coming down. So shareholder approval is very much required in those kind of scenarios. So all these things are the role of compensation committee. Then every company will have even a nominations. The board will set up what is called as a nominations committee, which is for the board itself. Right? This committee will typically prepare qualifications and what are the things that are required for recruiting board members. So it is more responsible for recruiting new board members and even reviewing their experience and skills, because see, if 4 members go and 4 members come, it has to be made sure that the skills of the people who are leaving is exactly matching with the skills of people who are coming in. Let's say the people who are going out are all from a legal background, but people who are coming in are from an accounting background. So probably the company is having too much of accounting expertise because of more accounting people present in the board, but it is lacking legal expertise heavily because all the legal people might have left. So make sure that whosoever are leaving, accordingly itself the positions are typically filled. So it will actually go for nomination procedures, policies, and even when a senior management is leaving, let's say CEO of the company is going to leave next year, it's the responsibility of the board to come up with a succession plan. Right? Probably when Ratan Tata is about to exit, now the board will come out with a plan saying who will be the next successor to Ratan Tata. Because it's not Ratan Tata who is alone responsible for Tata's business. There are so many shareholders involved in the process. It has to be clearly ensured that whosoever comes in as a successor to Ratan Tata should be as efficient. So it's no more a family business, right? These are all no more family businesses. The moment shareholders are coming into picture, these are no more family oriented businesses. So the board has to be there. The board approvals have to be there. All these things will typically come into picture. Even recently we have seen when Narayan Murthy wanted to join back Infosys, he has even taken his son along with him. But the instructions were very clear that his son's role is only as an executive assistant to him, but not with an intention of he becoming the CEO of the company. Probably in politics we can do the dynasty politics, but in this kind of scenarios, okay, as long as you have 80% of the shares, your family only holds 80% of the shares, probably just by succession you can become the next. But if the family is holding only 10% or 15% of the shares, then probably anyone else also can become the majority. Anyone else can take up the role of the chairman and the next successors in the company. Now, the code of ethics standpoint. So, every time you have to make sure that the investors are updated with the relevant information and make sure that no insider purchases the shares before the shareholder can purchase, because these are the guys who have access to information earlier compared to the end shareholders. Make sure that these people are not using that information for wrong purposes. So if at all the company is dealing with Citibank and getting a $100 million, few $1,000 million project with them, It should not happen that the management and the board, everyone have bought the shares of the company now, thinking that once the approval is happened for that project, the share price will drastically go up and we'll sell our shares. So such kind of insider trading kind of activities need to be prohibited, and the board has to take enough responsibility of ensuring all those kind of things. And so the board has to make sure that the code of ethics which are being performed are very strong. Every rule of the corporate, there should be a kind of designation for who will be responsible for the corporate governance activity, because weak ethics can very well, some of the things, transactions with the related parties, it's not that you should not do, but they should be disclosed. See, basically it may so happen that my relative's company is my supplier. It's not that I should avoid them, but I should disclose them. A good code of ethics is whatever the transaction that is being done with respect to the related parties. Related parties are the ones who are very much linked to the senior members of the company, right? You can very well do a lot of transactions with them, but disclose each and everything, and also look at the personal use of the company's assets in very small layers. You will see, right? Probably a company giving a guest house to its employees. That guest house is being used for renting purpose. You are renting it out to someone else, or probably the company is giving you a luxurious car because you are a senior member of the company, but you have sold the car somewhere else. So these kind of things are probably you are using it for some taxi purposes, personal uses. So those are some of the things which are a part of the weak code of ethics of the company. So activities benefiting the insiders are completely the weak code of ethics. So anything of these things they have to be vigilant of. The board should be vigilant of, and they should restrict the management from getting into those kind of activities. And few things relating to the voting rules, because for every person, for every shareholder, even if he is holding one share, the voting is a primary right. If he wants to vote, he should be permitted to vote. And for there, you make sure that the proxy, what is the stance of the company with respect to the proxy voting? What do we mean by proxy voting? Probably it's like this. Let's say the company has held an annual general meeting in Delhi, because the head office of the company is in Delhi. Let me assume that they have held the annual general meeting in Delhi. I am a shareholder in Hyderabad, holding 2 shares of the company. Why will I go till Delhi to execute my 2 votes? So there, what all could be there? That is where proxy is coming into picture. Probably I may nominate my broker to vote on my behalf, right? Because that broker will be having so many other members like me who would have nominated him. Probably you go and probably he is someone designated in Delhi itself. I may instruct that person to vote on my behalf. Whatever my decision, I will inform to him and I may ask him to vote on my behalf. That is what we are calling as proxy. Now, some companies intentionally they don't allow proxies. It's a very wrong sign. See, probably I should be allowed to vote even through a postal also. Even the political elections they allow for postal ballot. So voting can be done in any manner. But if a company typically doesn't allow for proxies, probably there could be a intentional thing to reduce the number of votes so that their proportion goes up, right? Because anyhow the promoter will have those much percentage of votes. But for some decisions, let's say 75% of the votes are necessary. But that person is having only 50% of the votes. The remaining 25%, if everyone comes and votes, probably the whole thing is only 50%. But if half of the people don't come and vote because of various problems, then it's 50% itself is 100%. Right? So that is where probably what we have to see is what is the company's stance with respect to proxies. Are they allowing proxies with full flexibilities? Or are they very much restricted in terms of proxies? Or are they putting mandatory attendance? Only if you are physically present, you will be allowed to vote, otherwise, you are not allowed to vote. That's a kind of probably negative thing on the company. Even through post or even through proxies, I should be able to vote. That's one. Two, this is a very funny thing. Any company putting their AGM dates conflicting with other companies. Probably two big companies, A and B. Because these two are big companies, every investor will hold some shares of both the companies. And let's say one of the companies out of these two, let's say A, does not want people to vote on some important decision. What it will do, it will put the AGM on the same day when B is conducting it, probably in a different city. B is conducting it in Delhi, A may conduct it in Bombay on the same day, same time. So obviously it knows some of the people will not attend it. Because if two big companies are there, probably every investor might be having the shares of both the companies. So that way I am reducing the number of votes coming in. These are some kind of bad practices of the company. And allowing the proxy through a remote mechanism other than a paper ballot. Will they allow any other mechanism? The more the number of mechanisms that are allowed, the more is the transparency, and allowed to use share blocking. A very bad practice. Share blocking is probably whosoever is attending or 2 days before the AGM and 1 day after the AGM or 2 days after the AGM, you are not allowed to share in the trade. You are not allowed to trade in the shares of the company. That is an indication of share blocking. The company does not allow you to trade in the shares of that company, especially if you are attending the meeting or if you are getting into the voting process. So these are all sometimes what the companies do is they try to pull down the investors. So if any of these practices are followed, you should be very much vigilant about them, because they are not there. There is something going within the company which is not in the interest of the shareholders. So some of the things that need to be ensured is the voting completely unbiased, right? Probably sometimes what could very well happen, you may vote for something and as a part of the tabulation, probably the votes, whatever you might have voted against, but in the system it may be treated as you have voted for the motion. See, at the end, if everything is software, you can very well play around with it, and even a reject decision, you can take it into an accept decisions or whatever you want. So make sure that even the party who is tabulating the votes, even that is an independent party. The voting records are maintained with that third party. So as a investor, like a right to information kind of stuff, if I typically want the information about the voting records, they can be supplied to me. That brings in more and more transparency into the process. Even the tabulation mechanism is audited, and whether there is anything regarding the confidentiality regarding the proxy voting. So it ensures that all votes are counted equally. When the more and more confidentiality is there with respect to proxy voting, just like a physical voter, even a proxy voter's counting happens in the same way, which means equally valued across. Now, there is one more concept that we have to be understanding in this context called as cumulative voting. See, logically speaking, there are two ways. Now, let's say you have some number of shares. Let's say you have 100 shares. Sometimes what happens is you have the flexibility of using this entire 100 shares. There are two types of voting. What you can typically do is all these 100 shares, you can vote to one single person. You have 100 share means you have 100 votes. So you can vote to one person, or you can distribute your votes. It goes like that. So basically either all your 100 votes can go to one single person. So which means finally the way it gets decided, you look at it like this. Let's say your 100 votes are there, right? In that 100, you are saying you have to choose only one person. So for 100 shares, you may choose one single person. Or the other side, your 100 votes, you can split across multiple people. And the total is cumulated, which means because I have to vote for 10 people, right? So basically it's like you are voting, the 100 shares are being used for people. So it's like this. Probably the better way I will explain it. Let's say there are 1, 2, 3, 4, 5 participants. 5 people for the board, and now you have 100 shares with you. So you can very well say, I'll give 20 shares to this person, 30 shares to this person, 50 shares to this person. So which means all your 100 are being split like this. So whosoever, let's say there are only there are 5 board members. So probably there are 8 members who are contesting, and 5 will be selected into the board. Your 100 shares, let's say you have given like this. This is called as voting for one share. One vote per one share. One vote per one share. To whosoever you are giving, this is a one vote per share kind of a mechanism. When I say cumulative voting mechanism, it's like you have 100 shares and each share has to vote 5 people. So probably you have 500 votes. Because you need 500 directors to come in. 5 directors to come in. Right? You are given completely 500 votes. This is what is called as a cumulative voting. So, or probably you look at it like another different way. Let's say there are 5 people. 2 needs to be selected. I may ask you, okay, with your 100 votes, you select one out of these 5 for the first position, another one for the second position, right? So in that case, what could happen? At any point, your contribution is only to the extent of that 100 votes. Whether it is for first director or second director or third director, it is for that 100 votes only. But in the cumulative case, you are given 200 votes because 2 directors, 100 share per each director. So instead of giving per each director 100, I am giving you cumulative of 200. You put that entire 200 on one single person itself. So in that mechanism, what could happen? There is a chance one of your representatives can come up as a director very easily. Because you put all your votes on one single person. So even with a limited portion, so it's basically, otherwise, let's say there is a person with 50% of the shares, the promoter, right? Now, if I say, okay, I'm the person, I'm a director, I'm standing as a director, you cast your votes. Now, all your 50%, if you give to me, I'll become the director. If you don't give to me, I'll not become the director. Even if all of these guys give, I will not become the director because your votes are more than 50% to me. If you give, I'll become the director. If you don't give, I'll not become the director. So, every director is dependent on you, on the promoter. Getting the scenario? Let's say I'm making 10 directors stand in a line. For each director, I am asking the votes. So here, if you give the vote to that director, he'll get more than 50% of the votes. If you don't give, he'll get less than 50% of the votes. So he will not become the director. Straightforward. So the whole power in terms of appointing the directors will lie with the majority stakeholder in the regular voting process. But if I say cumulative voting, now you have 50% of the shares, means at the max you can vote 50% of the directors. Because another set of people have 50% of the shares, and for that 50%, I'll give, if there are 10 directors, I will give you 250 shares, 50 shares into 5 directors, or 10 directors, I'll give you 500 shares. I'll give the others also 500 shares, or 499 to them, 501 to you. Now, in whatever proportion you are putting, you can bring only 5 directors at the max. These people can bring another 5 directors. So, in that case, what is happening? Even a small shareholder, he can nominate a director to the board. So, that is what is the cumulative voting kind of a process. You have to typically see whether this company is following one vote per share kind of a mechanism, or is it allowing for cumulative voting, especially for the appointment of for the voting relating to the directors. And a few more things. Any nominee, if a shareholder is sponsoring any of his member to the board, what is it the company is typically, or what is the board typically examining in that case? So, are there any flexibilities in terms of me nominating some of the members to the board? See, again, it's a voting process, but at least can I nominate them? Right? What are the mechanisms? What is the flexibility I have to nominate a member to the board? Or what is the flexibility I have to remove an existing member from the board? What proportion of the votes need to be collated for removal? What proportion of the votes need to be brought in for bringing in a new person? And what are the things that the company's policies with respect to shareholder sponsored resolutions? Because sometimes the shareholders may raise some issues or may question the board's performance, because the financial performance is going down, or productivities are going down. Something is happening with the company, and one of the shareholders has raised it as an issue. What is the importance that is being given to it? Are they addressing the problem? Are they highlighting that problem and responding back to the shareholder? If those are happening on time, there will not be much of an erosion in the shareholders' value. Otherwise, there could be a big erosion in the value of the shareholders, because many of the people may not like the board, may not like the way the company is working. So they may in turn get off to sell off their majority shares or minority shares in the company. So even from that standpoint, and even the classification of the shares, some companies do have the mechanism of dual values. They'll say some of the shares, one share equal to 10 votes. For some shares, one share equal to one vote. That is what we call as dual class shares. See, it could very well happen that all the promoter shares, they may say one share equal to 10 votes, and all our individual shares, one share equal to one vote. In that case, whatever is the number of shares you accumulate, your proportion in terms of votes is very minor. So you will not have much of an influence at all in the decisions of the firm. So as an analyst, you have to really go through all these aspects before you decide. Apart from the financials, apart from all that stuff, from a company's management standpoint, you have to be vigilant regarding all these processes, especially if you are purchasing or if you are working on behalf of your clients, giving them investment decision, and even looking at the trust associated with the company. All these dimensions need to be looked at. And finally, even the company's policy relating to the takeover defense. If someone else is planning to acquire this company, what is the stance of this typical company? Is it willing to sell off with the shareholder approval, without the shareholder approval? Is it going to be a friendly sell off, or is it going to be a hostile takeover? And to prevent the takeover, is the company doing any of the various defense mechanisms? See, basically, some of the defenses that could be there are probably the let's say the golden parachute. It means if, let's say, A is taking over B, right? A is thinking of taking over B. What B's management may say to the B's employees is, when we get taken over, probably all of you will have the right to take a huge money from the company and quit the company. See, before the takeover happens itself, golden parachute is like a big offer, golden offer to the employees of B. Before the takeover happens itself, what the company B will do is, legally it creates a kind of sign off with its employees. Like, whenever A takes over B, you have the right to get a one-time full payment and leave the company. So A will stop buying B immediately. This information will be conveyed to A. There is a legal agreement between our employees. So all the top-notch people of B will leave with immediate effect, taking a big money. So it will have a negative impact on the performance, on the financial performance as well as operating performance, because there is a big cash taken out. One, two, even the top management is not there for B, which means now A has to start everything from scratch. So there are so many anti-takeover defenses like this. So whether the company is typically looking at any of these anti-takeover mechanisms, or is it simply surrendering off? So all these things have to be carefully evaluated as a part of the corporate governance practices of the company. Right?